Selling options is my favorite option strategy because it is very low risk, especially selling calls, which is what we're going to focus on today. I have a video on selling puts, and I'll put a link to that video down below. First up, we're going to go over the basics of selling calls, then we'll walk through the numbers, and I'll give some final thoughts on risk. We're looking at Krispy Kreme. Click the trade options button, and here's our familiar screen. Make sure we have sell and call selected at the top. It's going to show us the current price right here in the middle. In the money contracts will be below this price line. Out of the money contracts will be above. Strikes will be shown in rows on the left here, and the option premiums on the right. We'll have a drop down for our expiration date at the top. When selling a call, you're going to receive the premium, and this premium is yours to keep. But in order to sell calls, you must have at least 100 shares of the stock, and you're agreeing to sell your shares on or before the expiration date at the chosen strike price. Now we're looking at Krispy Kreme. So if we select an expiration, let's say 1 month away, March 21st, we'll see that at a strike of $10, that'll net us a premium of $25. We have to take this times 100 because options are sold in blocks of 100 shares. Now, if you already own this stock and you are selling calls at a strike above your cost basis, you won't lose money on this trade. And if you say, okay, but I could lose opportunity or have potential loss, I think that's an unfair position to take when trading. And if you select this trade right here, $25, I think it's unfair that Robinhood will show us that we have unlimited max loss here with this graph here. This is misleading. This isn't loss. They are pointing out lost opportunity. Once we run through the numbers, we'll come back and I'll cover my take on this lost opportunity here. Now, if you buy this stock for the sole purpose of selling calls, then you are taking a riskier position, and it's possible to have unrealized losses up to the price that you paid for the stock. And interestingly enough, Robinhood doesn't show that loss. This is why I only sell calls on stock that I already own, or if I want to sell calls, it's stock that I want to own and like anyway, even if I didn't sell calls. Now, let's flip over to the spreadsheet and let's take a look at how this math works out. Looking at stock XYZ, let's assume that the current price is $10 and we are going to sell a call 30 days out. Let's assume that we bought the stock today. So our cost basis would be $10 per share. And let's assume that we are selling at a strike of $11 and that we are going to receive $30 in premium for selling this call. Let's run through the different scenarios of what could happen to this contract. Scenario one, stock stays below $11 at expiration. The result of that would be the contract would expire worthless. We would keep our $30. So let's go and put the $30 in our profit column right here. Scenario two is the stock is $11 or higher at or before the expiration date. The result of that would be the stock is sold at $11 per share. We would keep our $30 in premium, and our profit would be $130. Because remember, our cost basis is 10. We're selling at 11, so we made $1 per share, $100 on our sale of stock. We would keep the $30 in premium, $130 profit. Scenario three, let's say that the stock falls to $1. Maybe not a likely scenario, but I guess that could happen. In this case, the contract would still expire worthless. We would keep our $30 and we would have an unrealized loss of $900 in stock. But remember, we keep our $30, so we would have an unrealized amount of $870. Unrealized again because we still own the stock. We haven't sold it yet. If we did sell the stock, that would become a realized loss. Then we have scenario four. The stock rises to $16. The result, just like scenario two, the stock would be sold at $11 per share and we would still keep our $30. What we would have is $130 in profit. I know that a lot of times people call this a loss. And the way that they do that math, potential loss, is they say, well, My strike was $11. The stock is now 16. So I lost out on that extra $5 per share, $500. I still received the $30 in premiums. I would have a potential loss of $470. Now, as I said before, I think this is unfair. So let's flip back to Robinhood and let's walk through that scenario. Potential loss is all about ifs. When people say that I sold a call at 10, the stock rose to 16, I potentially lost that money. I would have had more money if I would have kept my shares instead of selling a call. What you're talking about is ifs. If I would have done this, then something else would have happened. Dealing with ifs is completely unfair because you can't play out this if scenario with success. Let's take a look at Krispy Kreme right here. Let's say that you had purchased Krispy Kreme at $10 and sold a $12 call. Right here, you would have made $2 per share on your contract. But look at what Krispy Kreme did right after that. It rose up to $15. So you could easily say, look, I lost out on that $3 of gain that Krispy Kreme did after I sold my call. But the thing is, you're playing an if. You're saying, if I would have kept my shares and if I would have sold them at the top, how would you have known to sell it right here, right at the top? There's a good chance you wouldn't have. You don't know what you would have done. Maybe you would have seen this go up and up and up, and you would have been, maybe you would have said, hey, I'm going to ride this out. And then it went up and down for a little bit, and then it went up again, and you're like, okay, I'm going to hold on to my shares. And then it dropped down to here, back down to 12.95. How about that if scenario? You didn't sell here because you thought it was going to be more, and then it came over to here and you did sell it at this point. You don't know you would have sold here, and you don't know that you would have sold here, and maybe it would have fallen down here and you would have sold here and lost more money. So you can play this if scenario out a whole bunch, but you don't really know what would have happened. Even if you were the type of person that said, nope, I know for a fact I would have sold right here. And I know for a fact then I lost potential money there. Okay, let's run out that scenario. You sold a call at $12 and then the stock ran up to 15. So you lost out that potential amount of money between 12 and the $15. Okay. Well, what about the if scenario of when you made $2 per share and you took the extra money and you invested it in one of my favorite stocks, Senseonics. What if you would have purchased, what if you would have purchased Senseonics at 31 cents with that $200? And then a couple of months later, Sens is now worth $1.24. You would have made a lot more money doing this. You would have tripled your money doing it this way. So if you're going to play the game of if I wouldn't have sold a call and I would have sold my shares at a higher price, well, then you also have to play the game of, well, if you did sell a call, what would you have done with that money? So the if scenario can go on and on forever. When selling calls, make sure you're picking a strike that is above your cost basis and is at a price that you're willing to let your shares go at. And don't think about the ifs and the potential losses. You have a cost basis, you're selling the call for over that cost basis, you're willing to let your shares go for this price. So take the premium, take your profits, and invest in something else. And if you have questions about selling calls or any other financial questions, leave them in the comments below or come check out our Discord. We have 100,000 members. Myself and other experienced traders are in there every single day answering questions and helping people level up their trading game. Thank you for watching, and I hope to see you in the next video.